As we sit here today, the S&P 500 index is down over 15% from its all-time highs in just 7 trading days and is back down to price levels last seen during fall of 2019. Global stocks started the month in rally mode after shaking off initial fears of the spread of the coronavirus during the last couple weeks of January. The S&P 500 index was up over 5%, making a new all-time high on February 19th. Then, alarming news about the rapid spread of the coronavirus outside of China, combined with revenue warnings and profit warnings for many high-profile companies citing supply chain disruptions throughout Asia, sparked an initial market pullback, which then led to a significant market sell-off during the final week of the month. The very rapid, indiscriminate, sell now, ask questions later nature of the sell-off leads us to believe that this is most likely as much about programmatic and systematic de-risking from algorithmic traders in the hedge fund community as much as it is about real coronavirus fears. It's important to remember that all client portfolios were near or below their long-term equity target weights heading into this sell-off, which helped cushion losses somewhat. Additionally, all portfolios were overweight high-quality bonds, which have performed very well and generated positive returns as interest rates have fallen to new all-time lows. The US 10-year Treasury note is now down to a yield of 1.16%. That's 0.2% lower than the prior all-time low reached in June 2016, and the 2-year Treasury note now yields 0.9%. As long-term fundamental investors, we believe the market and economic impact of the coronavirus will be transitory. The question is just how long. And a few things we're keeping in mind as we continue to closely monitor this rapidly evolving situation. One, many global stocks just got anywhere from 10 to 30% cheaper over the course of just 7 days. And it's highly unlikely that the long-term earnings growth potential of many high-quality companies has actually deteriorated that much in that short a period of time. Second thing is global stocks have gotten 40% cheaper relative to high-quality bonds. And the last thing, although short-term high-quality bonds have done a great job cushioning portfolio losses, they're now yielding less than 1% compared to current inflation of about 2%. So they have become a much less attractive long-term investment. With some areas of the global equity market and some individual stocks starting to look pretty attractive, what are the things we're watching that would lead us to feel more comfortable buying equities? First, we need to see some evidence of investors stepping in to buy the dip. In our view, this would most likely occur when we see more extreme signs of selling exhaustion, combined with news about the coronavirus at least stopping getting worse. It doesn't necessarily need to get better, but needs to stop getting worse. And finally, we would need to see more support coming from global central banks, particularly the Fed, which needs to change their tune and start signaling that they are willing to cut interest rates and purchase more assets in order to calm markets. Currently, the market is pricing in 3 to 4 interest rate cuts during 2020, and the Fed is scheduled to meet March 17th and 18th.